What is going on, investors? Hopefully, you guys are having a great day out there. Time to talk about the Walt Disney Company, ticker symbol DIS. The company reported their Q3 earnings after the bell, and it is popping, baby. This thing's up about 6%. That's about $10.20 per share. I'll draw a line on the graph where we're at now. We were down here with the stock, and now we're popping up above here. We'll talk about what that means from a technical perspective here in a minute. Now, this comes off the heels of reporting earnings. I will get into these earnings. We'll talk about the subscriber numbers, talk about the all-important parks division, which we'll talk a little bit, compare it back all the way to 2019, because obviously last year is a tough comp for it. We'll see if that's all the way back. We'll take a look at the Disney Plus subscribers, see if that business is making money or not. And we'll take a look at just in general the financials from a revenue and profit perspective, see how Disney is going. Now, they did suspend their dividend a little while ago, but hey, I tell you what, has not derailed the stock. Over the last year, this thing's up 36%. And like I said, that doesn't include the after hours pop, where we're seeing this thing's up a strong 6% in the after hours. So the financials and the subscribers top the street estimates. That's on the headlines. Total subscribers for Disney Plus came in at 116 million. It says here that they were expected to be at 112.8 million. I was reading an article earlier where they had it pegged pretty correctly, saying it was estimated that Disney Plus had 117 million subscribers. So the street already kind of knew this. I don't necessarily think that is popping the demand. So let's jump into these numbers. We'll see if we can see anything here. Obviously, Disney has a few different business models. So they have Disney Media and Entertainment. This is ESPN. This is ABC. This is the Disney Channel. These are all those types of things. And then you have the Disney Parks experiences and products. So all the little licensed products that you buy either at a Disney store, even like on Amazon or something like that. Disney collects a small royalty on that. And then obviously the parks, the cruises, those types of things. And obviously that business has been impacted tremendously over the last year or so. We see here our Disney Media came in up 18% from $10.7 billion up to this $12.7 billion. Now, Disney Parks and Experience, okay, that is up huge, okay, but investors are understanding what's going on here. Okay, last year in June of 2020, everything was shut down. Almost everything was shut down. Certainly the park out here in California for Disneyland was shut down. Now I think they're both open, the one in Florida and the one out here in California. I think they have one in China as well. I think they're all open, but they're all due to limited capacity. And so what I want to show you here is here's the $4.3 billion on this park side. You might wonder, well, okay, last year they made $1 billion, but that's not a fair comp, okay? Where were they in 2019? So I pulled up, this is a third quarter 2019. So we're really doing like 2 years back, but that's when we have like a really clean way to look at the park segment. Notice that they were doing $6.5 billion on the parks. So at least another $2 billion until you get quote unquote back to normal with Disney. Now I read through the press release, the weakness still, the fact that we have not come back is due to primarily two things. Number one, the cruise ships are not operating for Disney and not operating for anybody. And we also have the parks at limited capacity. At least I'm not sure how it is in Florida, but out here in California, they are still operating under limited capacity over at Disney. Now, in terms of segment operating income, okay, off this $12.6 billion, this is ESPN, those types of networks, they made $2 billion. Now, that is a decline year over year, actually down 32%. So while you saw the revenue increase in that division, cost obviously went up because they actually earned less money. They earned $2 billion versus $2.9 billion. Now, the Disney parks and the products are running essentially at break even, $356 million off of $17 billion worth of revenue, relatively pretty much a rounding error. So it shows you we're basically at a tipping point with the parks, okay? Last year off $1 billion in revenue, they lost $1.8 billion. So they were just bleeding money. That has evaporated and things are looking a little bit better there. You might be interested in what did they earn off the parks and experience back when everything was all normal again. Whether or not we get back to that time, I guess, is up for debate. But $1.7 billion, you notice they earned $1.6 billion. So the parks division can add another billion, at least another $1 billion, probably another, maybe even $1.5 billion if and when it gets backed to 2019 levels. We'll see if Disney's able to do that. Now I'm going to close those so we don't get confused with 2019 numbers. We are looking at the most recent quarter. Here's the Disney Plus subscribers. Those came in at 116 million. It was at 57.5 million a year ago. ESPN Plus really surged, okay? Went from 8.5 up to 14.9. I know they're looking to add more content to that, more live sport content, especially critical content like the NFL and those types of things. That should drive subscriber growth there as well. All things being considered, the subscriber growth on these types of things looking absolutely fantastic. Now, what I wanted to show you here was I wanted to bring up the parks and experiences and the fact that there's parks and experience. So this is when you go to Disneyland, you buy your ticket to get in, you go on one of the Disney cruises, you buy a ticket, all that type of thing. Notice that the revenue for that is at $2.6 billion. You still have this strong consumer product business, okay? And this just shows you how much the parks and experience just simply have not come back. Okay, consumer products went from 736 million. Again, a lot of these get bought on probably on the cruise ships, certainly at Disneyland and those types of things. But you can buy these. Probably my kids have been buying Disney stuff all during the last year. So yes, we've seen some growth here, but it just shows you that this park division, when we talked that there's at least $2 billion that they are able to bolt onto this revenue if and when things get quote unquote back to normal. Well, most of it's actually probably going to come to this parks and experience side, okay? The ticketing, the cruise ships, those types of things. And you see here for the parks and experiences, they are literally at break even. In fact, they're still losing a little bit of money on the parks and experiences. It's really those consumer products off this $1.15 billion. You got to love the licensing business. Operating income over 50% to $564 million. So as you see the parks come back, it should bolster up our consumer products up a little bit, but it'll definitely move this into profitability. That should be bullish for the Disney company as well. Now, let's take a look at that was kind of granular stuff. We kind of look, again, we're focusing primarily on the parks and entertainment because in my opinion, yes, this media division, this is going to continue to grow, but you have a push and pull between ESPN fees that they collect and they can't collect, people cutting the cord and etc. It's really this Disney parks and experiences that has the largest room to grow. I think you're going to expect year over year between probably 10 and 20% growth on that top line of that media division. But the Disney parks, I'm telling you, this is going to grow 50% over the next year, maybe even 2 years. Again, cross our fingers. Hopefully things get back to normal. People can go on these cruises. More people can get crammed into a Disneyland. Those types of things, certainly from an investor standpoint, would be awesome. Now, from a revenue perspective, we ticked up to $17 billion. This is our quarter ended. Left-hand column is the most recent quarter. Right-hand column is last year. Went from 11 billion up to 17. Again, most of that due to the fact that we have parks reopening. They're able to recognize some revenue there. We've got cost and expenses coming in at 15.6 billion. We were at 11.7. We have some other costs here, but all things being considered, here's our income from the operations. So this is our revenue minus our cost. Income from operations sitting right, we'll call that just $1 billion. Okay, last year we were just, money was flying out the door over at Disney. Okay, this is why they had to cut the dividend. They weren't really sure. Nobody was really sure how long Disneylands would be closed, how long they have to have them at really low capacity. Well, we've kind of turned the corner on that. Okay, Disney is now at a capacity where they can break even on the parks. And again, if we can get things continually under control here in the United States, and in my opinion, I have a rosy outlook on these things. I think things are moving in the right direction. I think by Q4 and Q1, Q2 of next year, 2022, I don't want to say things will be all the way back to normal, but I think things will continue to move in that direction, hopefully. Now, they've got some income tax benefit. They cleared $1.1 billion on that net income side. That's good for 50 cents per share. I don't know. Again, a lot of you are probably watching this. You're wondering, hey, when is the Disney dividend coming back? When will they do that? I don't know. I think they'll probably wait as long as they possibly can. The new CEO, obviously Bob Iger, I think is out now. They got a new CEO. I think really what he'd probably want to do is reinvest this money instead of diming it out to shareholders. He's got competition over at Netflix. He's got competition at other movie studios and those types of things. He probably would rather just keep this money and reinvest it in the business and take a look. Look, look, yeah, the dividend was nice, but this stock's up 36% a year over year. And boy, it's had a nice run. And even today, it's up another 6%. Now, in terms of cash flows, the balance sheet, we'll get to cash flows in a second here with Disney. So the balance sheet's nice. As you'd expect with a mega cap company like this, they've got some cash here, about $30 billion. They do have some liabilities in terms of debt and borrowings and those types of things. And you'd expect that with Disney, especially because they have to produce a lot of this content, build big studios, ESPN facilities, pay contracts, pay people up front, and collect money over time through advertisement, ticket sales, those types of things. All things being considered, as you'd expect, the balance sheet's super nice over at Disney. From a cash flow perspective, things look a little bit better, obviously. Well, I thought what was interesting is last year from a net income perspective, this is why cash flows is a difficult financial document for people to understand. And for the most part, I would say it plays third place. I would say your operating income, your profit and loss statement, this is what most investors gravitate to very quickly. Your balance sheet will kind of give you'll be able to play off that. If the company's making money or losing money, you want to see how that translates over to cash on the balance sheet and those types of things. If a company's going to be making acquisitions, you like for them to have cash or the leverage to get that cash. With Disney's sake, look, cash flow's a little awkward, okay? Net loss last year was $1.8 billion. This year, $2.2 billion positive income for the last 9 months. Take a look at cash provided by operations. Well, last year was higher, okay? Even though we lost money over the last 9 months, it was actually higher last year. So cash flow's a little funky. They get to add back some things, get to take things out. With these licensed content and those types of things, the cost with those, they're amortized somewhat oddly, okay, when you look at Netflix's cash flow. So I wouldn't really worry about it from that sake. Now, all things being considered, again, we're not paying the dividends for the last month. Last year, we paid out $1.5 billion worth of dividends. Now we're not paying that. Okay, so that's kind of interesting as well. And again, I wish I had a clear answer if and when Disney will, add their dividend or bring back their dividend. They certainly have the financial wherewithal to do that, but I don't necessarily think this CEO is going to be actively willing to jump into that, considering they still have some hurdles to cross. We talked about how they're essentially running at break even on these parks, and that could continue through the rest of the year. And so we'll see, even though I think we're moving in the right direction, I think we're still a ways away from full capacity over at Disneyland. Hopefully I'm wrong about that, because I got 2 kids that probably would want to go. Now, moving over to the stock chart, this thing has been consolidating within a pretty tight range, actually, since December of last year. It's really been consolidating between $170 and up to about $200 per share. But more precisely, we were consolidating over the last few months between $170 and about $185. You see here that initially this stock gapped up here to $170, hesitated for a second, then basically rallied hard up to 200, came back and found support at 185, and then boom, zip back down to the bottom end of our range, down to 170. And where are we in the after hours? This is why this is actually kind of an interesting session in the after hours, is we've actually jumped back up into the upper end of this range. So the stock is sitting right under $190 per share. So a couple things could happen with Disney. Now we're up in this upper end of this range. I'd actually expect the 184 to 185 level, which is $3 or $4 higher than where the stock is trading at right now. I would expect that to act as a level of support now for Disney. So this area where we're at right now should act as support. So if Disney were to sell off tomorrow a little bit, or over the next couple of days, just kind of come back down to earth a little bit, investors digest things, well, I'd actually expect that to add a level of support. Now, if we break that level, you're looking for buying opportunities down here south of about $180, $175 per share. Now, the other scenario that we have with Disney is now that we're in the upper end of this box, anytime we've gone into this box up above $165 per share, look, the stock has wanted to go to $200, and guys, that's a good $10, $12 higher than where the stock is right now. That's almost 10% move. And so you could play a move up to that $200 level with Disney. You want to buy here at 188. Maybe put a stop loss down here at 184 and you play the pop up to 200. Now, a really bullish thing is if we can continue this move and break above 200. You can bring up charts like maybe Facebook. I have a Facebook chart right here. Again, this was sideways consolidation. Once it broke above the $300 level, I mean, this thing rallied like 20%, okay? And there's other examples of that too. We're kind of waiting for Apple to do that as well. Apple was in a really tight range, busted above highs, and it looks like to me this thing wants to push higher. Same thing could happen with Disney. Again, I'm giving you the ultimate bull case that we not only get here to 189, but over the next week, month or so, we push all the way up to 200 and then over and above it. That's a tall ask. We'll see what happens. But I just wanted to point out your support and resistance zones, at least where we're at right now at $189. We've got absolute support here at 185. We're going to have resistance up there at $200 per share. If we break this resistance at 185, we've got support down here at 170. Those are buying opportunities. In my opinion, you pull back to 170 on Disney. Considering the environment with all the things that are going on in the world, you have to factor all those in if and when Disney stock gets back down to 170. Now, the ultimate bull case is we get above 200 because then the sky's the limit. This stock could add 10, 20, 30% onto its market cap and in the share price, in the matter of weeks once you get above that level, because momentum takes over and there'll certainly be a lot of attention on Disney at that time. That was Q3 earnings for Disney. Hopefully, guys enjoyed this video and you're having a great day out there. Thanks everybody for your support. We'll be back again soon with more videos. Of course, good luck with your investments.